So where do I see the major currencies heading in 2018? So dollar weaker versus the euro, the yen, and sterling. I think there's going to be a focus on current account, in other words, surpluses, especially Japan and Europe, massive surplus nations. Sterling has been discounted and is cheap for a different reason related to Brexit. Brexit maybe starts to finally move forward, and the U.S. is going very much the wrong way with its budget. And if Trump gets his tax reforms through, which it appears he might, that's going to worsen a lot more in the U.S. And the Fed slowing down its quantitative easing and actually reversing quantitative easing, becoming QT or quantitative tightening, is going to make it even worse. The euro, we see it higher on returning to broader fair value. It's still a little bit cheap. It's gotten far less cheap. And as the ECB tapers its purchases, as it purchases in January 1st. Plus, again, that ongoing massive current account surplus. Longer term, we have some concerns about Europe and all the similar issues that dogged Europe with the peripheral debt crisis back in 2009, 10, 11, 12, especially as we see very different ideas about governance and about the government and what the EU's role should be in the likes of Central and Eastern European countries, Poland, Hungary, even Austria to a degree, versus the traditional core. We think Merkel's leadership has been weakened in this election, et cetera, et cetera. So Europe is going to have to long-term get its act together and either become more integrated, or it's going to need to spin apart into smaller component parts. And but that's a very long-term issue. The yen is the cheapest currency of the majors, probably. Cheaper even than sterling on a fair value basis. Hard to believe, but that is the case if you adjust for CPI and things like that. And it's especially cheap given the strong growth. The only thing keeping it down is the Bank of Japan's crazy, wild-eyed monetary policy, which again, if interest rates rise, it could make the yen even cheaper, but there's some big snapback risk, significant volatility risk if it normalizes policy, steps away from that, yield curve control, etc. Sterling, we have our hopes to the upside, but it does need to see more progress on Brexit. This is one of the first most promising signs actually this week on that front. And actually, since I can simply share my whole screen, I can get to a chart. I don't need the charts I was thinking about earlier. I can just get to a live chart. Swiss franc still too expensive, and it's not the safe haven it used to be. There's been all kinds of tax deals done with the U.S., with Germany to avoid the secrecy, banking secrecy of previous cycles. Not sure why that's popped up. And then we have the smaller currencies. We're not big fans of these. They're very poorly positioned for any kind of interest rate rises due to their housing markets, and their banks would need bailouts that transfer their debt to the sovereign balance sheet. And they still remain a little bit overvalued on average. Canadian dollar less so, but the Australian dollar, and especially we're concerned about the way China is going to transform its growth model as an especial negative for potential for Australia, because China needs to stop growing by sort of this brute growth of building too much and over-expanding infrastructure and construction, and needs to focus on transforming into a more finance-driven and consumption-driven economy. So you're going to see maybe less stuff getting dug out of the ground in Australia and sent to China. And there's some pretty hairy issues with the Chinese, how they plan to do this, but I think they're going to try to keep their currency stable. So there's been a lot of talk about the Chinese yuan being devalued. I don't think they want to devalue it, because that transformation to a consumption-led economy means you need a strong currency, and you want to encourage people to invest in China, and especially invest in Chinese assets and Chinese debt around the world, and see China as a source of stability, not of chaos and devaluation. So I think they will force their adjustments on the rest of the world by continuing to see nominal growth. So higher inflation and interest rates not maybe as high as the inflation rate, which helps you to reduce your debt, and forcing the rest of the world to make the adjustment. And even maybe pricing oil for trade in yuan instead of dollars. So that's a huge move that has massive implications for the US dollar's role as global reserve currency, and again, a massive issue that requires its own hour-long presentation. And then in emerging markets, we have some really some pretty attractive valuations here and there. in emerging markets, but we also have very, very bubbly asset markets in general around the world. So I think we need to be careful about entry levels. When you have given we think 2018 is going to be a little bit of a rockier ride with bigger ups and downs than we've seen in this record quiet in 2017, it means that when you have these market events, people don't like to hold things that are not very liquid, and emerging market assets and currencies are not very liquid. So it's a question of fading the panic and buying when they get even cheaper in many cases, rather than simply looking at what is the value right this second.